There are two types of stop orders: stop loss orders and trailing stop orders. There are also two different methods for placing stop orders, either predetermined hard stops or utilizing studies to determine your stops. There are also two different styles of trading, being continuation and reversal. And the way that you utilize stop orders to maximize your upside potential is very different in these two trading styles. By the end of this video, you will understand both of the stop types, the pros and cons of the two different methods, and how I make use of stop loss orders for each type of trading style. The first stop type is the stop loss. You all know what this is. Sometimes a stock is ripping, it matches your entry criteria perfectly on your trading system that you have proven to be profitable over time, and still the trade fails. In this instance, you must have and follow proper stop loss orders to keep your average loss in line with the statistics you have proven for your trading system. The second type of stop order is the trailing stop. This is where you get into a trade, it heads in the direction you expect it to, so you place an order a certain percentage or amount below the current price to protect your downside risk while still allowing the strength of the move to play out. So we've gone over the two stop types. Now let's cover the two different methods for creating these stop orders. The first of which is a hard stop. So I've whipped up a quick strategy here in which we're simply buying when the RSI is over 60, taking profit when the RSI comes back below 30. But I have developed my stop loss in case this price comes down rather than up at a 2% stop. Just hard if the stock goes down more than 2%, let's go ahead and get stopped out of this trade. And I've named those orders with stop so that we can see that happening. Of course, you can see some of the trades taking place on the chart here, and you can see when we enter, but the stock comes down 2% or greater before that RSI gets to 30, then we go ahead and we stop out at that point. Now, the number one upside to utilizing hard stops like this is you know what your max loss is on a trade, which allows you to appropriately and more aggressively size into positions. If I now hop back into my code here, I'm going to create a variable. Let's name it position size, and I'm going to set it equal to $10,000. I want to take $10,000 positions in each one of my trades. The next parameter on the add order type is position size. So go ahead and do 10,000 divided by close. Now, as I'm entering each trade, you will notice the number here below the strategy is updating. It's updating to the amount of shares you're buying. I'm now buying 10,000 shares in each trade because I know now that my max loss on the trade is only 2%, and I'm comfortable with losing $200 every trade. And the second method for placing your stop orders is a study stop, utilizing an indicator to signify where your trade will get stopped out. So I have changed our stop loss from that just straight 2% down hard stop to the entry price minus the ATR study, the average true range study, multiplied by 2. So now if the current bar closes less than the price we got in at minus the ATR study value times 2, then we get stopped out of the trade. So on this candle here, our ATR value is 2.85. What is that multiplied by 2? Something like 5.6 if I'm being sort of smart. So we get stopped out here at 60.32. Our entrance was at 65.9. So yes, roughly 5.6 is our stop out. Of course, the big downside to using the study stop is it's always adjusting, right? So you can't really have that same sort of confidence in what your max loss is per trade. You can't know that, hey, if I enter $10,000 here, I'm only going to lose roughly 200. You could lose more, you could lose less. Of course, you learn more about your average loss through this sort of back testing, which is why back testing is extremely important, but it'll never be the same like it is with a hard stop. However, that is also the major upside of utilizing study stops. I actually really like to use the sort of stop I just did in this strategy. I like to use the ATR because the ATR, once again, it's the average true range. It's measuring the difference between the high and low and taking the average of that distance over the last 14 bars and returning you a value. So the more volatile a stock is, the higher the ATR indicator goes. The less volatile a stock is, the lower the ATR value goes. And I enjoy using this as stops because if a stock is more volatile, I want to have a wider stop on it. I want to give it more room to breathe because naturally it's just going to move down larger in its normal volatility, right? Whereas if a stock is not very volatile, if a stock sort of starts chopping in a range, then I would like my stop loss to also tighten up, right? I don't need to have a wider stop loss on a stock that is less volatile. So I enjoy using the difference in measurements that comes with the ATR study for where to place my stop loss. Once again, it just comes with a con that other than the number we pull from our back testing, we don't know exactly how much we could lose if a trade does go against us. And this is the meat and potatoes of this video. This is where I'm going to spend the most time because I want to go over a handful of different studies and how I utilize those studies to set stop losses within my own trading strategies. But make sure you don't go anywhere because remember, the third section of this video was the trading styles, and it's imperative you understand the types of stops you should be using for the style of trading that you are performing. Now, in this section of the video, I'm going to be going over a handful of the trading strategies that I have created and use every single day myself. Obviously, mostly focused on the stop loss types that I'm making use of. And if while going over any of these strategies, you like the look of them, you think they might help make you a better trader, they're all available on my website, daytradingstrategies.net. There's a link in the description down below, but you'll get access to all of my trading strategies, both day trading and swing trading, as well as you'll get access to all of my custom indicators, scanners, watch list columns, etc. And they're all just for one low price. You get access to everything. I don't sell per code or anything like that. And they're all very easy to import into your Thinkorswim platform. You simply copy this share link and then back in your Thinkorswim application under setup in the top right, open shared item, paste preview, import. That then makes either the study, the scanner, or the strategy available for you to open. Simply search DTS as I make that the prefix for all my code. So once again, if you're interested in checking any of this stuff out, click the link in the description down below, go sign up, and become a better trader today. The first strategy we're going to look at, you've actually already seen. This is the strategy we went over during the intro of this video because I actually have 3 separate study stop losses all within this one strategy. My first is my stop loss order, and it is represented by the salmon colored line on the chart. What this is doing is it is taking the entry price minus the ATR times 1.5. So much like the last example I just showed, entry price minus an ATR multiple, that's our hard stop. Next, we are still using the ATR study, but we are basing it off of the current bar, basing it off of the previous bar closing price minus ATR, and we're using a multiple of 2.5. So we are using 2 study filters, but one of each stop type, your stop loss and your trailing stop, right? This, of course, taking the yesterday's bar close being 118.38, that bar's ATR being 6.9. That should be, 1.5 times 6.9 should be something like 10 points down. So from 118, your stop loss on this next bar is around 105, 106. Looks to be about right. I'm just bad at mental math. I'm sure the computer is doing the math better than I am. And then our third and final reason for stop loss within this strategy is another study stop loss, but this time looking at the percent change study. And if while in a position, the percent change indicator drops to less than -10. So if over the last 14 bars, the percent change is averaged to -10, then we also get stopped out of this trade. So 3 separate study stop methods, 1 hard stop and 2 trailing stops, all built into this same strategy. 2 of them using the ATR study, 1 of them using the percent change study. For our next stop example, we're going to hop into a day trading scalping strategy. Now, the study I am using for this stop is the RSI. However, it is not the normal length RSI. By default, the length setting on your RSI is 14. For this scalping strategy, I want my RSI to move faster. I want faster reactions on the study to the price movements since I'm scalping, so I lower that length down to 4. Now, the entry condition for this strategy is I enter when that 4-length RSI breaks below 15. Now, I will get stopped out of this strategy if that RSI level closes above 20 and if the current candle in which that RSI level is above 20 is still below my entrance price. So here we're looking at RSI divergence. If the price is going down, however, the RSI is coming up, I want to get stopped out of this trade. I see that, and I have proven that to be profitable as a negative move on the stock and a reason to use my study stop loss order. Next, let's talk about my reversal swing trading strategy, as this will be a perfect transition into our conversation about stops on different trading strategies. This strategy does not have a stop loss. And people will yell at you for that. Oh my gosh, Trey, how could you have a strategy with no stop loss? You're going to blow your account. You're going to lose all your money. But just keep an eye on these statistics up here as I begin clicking through the alphabet of stocks, and you will see this strategy does very, very well. Now, the exit for this strategy is the RSI closing above 45. So yes, you will still lose money in the trade sometimes. I'm not saying that I don't have a stop, so I never lose money. Of course not. But the stocks always bounce. Stocks move in waves enough that they bounce. So even on your losers, you're still getting a little bit of a bounce on the end of it. And I'll show you some examples in just a second as we're rounding out the alphabet here. This is how I really like to get a good idea of how strategies perform, as this is a great way to get a randomized subset of data across different sectors in the market, just clicking through the alphabet like that. But if I come into, say, NVIDIA might be a bad, let's go find a loss. NVIDIA's gone straight up, there's no losers. If I come into SPY, let's look at this trade here. So the strategy gets in, and yes, it takes a loss, but it gets out only when the RSI bounces back up and above 45. If you see over there in this level here, the RSI is back up and over 45 when it gets out. Can the strategy get hammered? Yes, of course it can. This is SPY during the 2020 COVID-19 drop, began scaling in the 310s, got stopped out, even on the bounce in the low 260s. Yes, the strategy can get hammered, but when you're talking about the two different trading styles, continuation and reversal, it is a battle of pick your poison. In a reversal trading style, you are looking for a very high win percentage and a lower risk reward. As you can see, my average win, $200, my average loss, $456. If I told someone those statistics without any other information, they'd be like, wow, Trey, that strategy sucks. But it's got a 91% win rate. And just clicking through other stocks and keeping an eye on that win rate up there, you'll see this strategy has a very high win rate, even though typically trading a lower R&R. That's what you're going for on a reversal trading strategy. Whereas back on our strategy with the multiple ATR study stops that we spoke on earlier, you'll notice a major shift. This is a continuation strategy. I am buying strength and then hoping to let that strength continue. And you'll notice in this strategy, I only have a 37% win rate. But my average win is just shy of $2,600, while my average loss is just shy of $800. In a continuation strategy, I am using much tighter stop losses while applying trailing stops to allow the profit to run out. So a continuation strategy, tight stops, looser profit targets. A reversal strategy, loose to no stops sometimes, and a tighter profit target. You're looking to lock in profits quicker on a reversal because you're buying weakness, so you don't expect a huge move out of weakness. You're going for that high win rate, whereas on continuation, you're buying strength, and you do expect a huge move when you're buying strength, but if you're wrong, you want to be wrong quickly, so you're tightening up that stop loss, lowering your win percentage, but greatly raising your R&R. And that is trading. If you take nothing else away from this video, please take this away. There's no such thing as a high win rate and high risk reward trading strategy. At least if you find something like that, you have found a golden egg, and the efficiency of the market will get rid of it eventually, probably sooner rather than later. Real proven systematic trading is a seesaw battle between the two, win percentage and R&R. If you raise one, you will lower the other. That's just how it works. Your job is to find examples of which you can get that seesaw to balance between win percentage and R&R so that you profit over time. Both of these trading styles have huge potential negatives. The obvious in the reversal is the crush of not having a tight stop loss. In the continuation, it is going through a very cold streak. If you have a win percentage of 35%, you could go 10, 20 trades without a winner if you go through a real bad streak. The point of trading, the goal you're trying to get to, is to have a playbook of strategies that combines the two, reversal and continuation. Those are the P&L graphs that you see consistently going up and to the right, because it allows you to capture both the pros and cons of each of the trading style, which help to average each other out over time. You don't want to only be a reversal trader putting all your money in the reversal trades you're taking, because if this happens, you'll get crushed. You don't only want to be a continuation trader, because if you go through one of those cold streaks, you'll get crushed. Your job is to build a playbook combining both trading styles and making use of now the stop types that you've learned in this video to maximize the potential of those trading styles. And once again, if you would like to easily add 20 plus more trading strategies to your playbook, sign up to the website daytradingstrategies.net. Link in the description down below. Thank you guys for watching. I hope you learned something. I hope you really take to heart kind of the last 2 minutes of this video in understanding that seesaw in that high win percentage and high R&R strategies don't exist. I hope you don't just brush it off as like, oh, well, I watched this one YouTube video with a 75% win rate and 4-to-1 risk reward, because no, you didn't. They were lying to you. I hate to burst your bubble. That's just not how trading works. You have to play the game of measuring the win percentage and risk reward. If you take that to heart, you really focus on that, and you think about that when building, testing, and optimizing your trading strategies, it will change your trading career forever. Hit like if you enjoyed. Make sure you're subscribed if you enjoy this content, and I'll catch you all in the next one.